Good morning.
Good
Pete,
morning.
how are
Don.
you? Welcome
Really
to
well.
Financial and Estate Literacy. This is fall 2022, how time passes when we're having fun. This is the It's Your Money series, and today we're going to talk about the investment world, which is a scary carousel of all these things to go. So what I'm going to do is I'm going to monitor the Q&A, and I will disappear. And as Pete said, I become the voice of God who comes in and asks questions along the way. And so
Michael, why don't you come on the screen? And we're going to introduce him in just a second. But the topic on this particular one is the investment world, how it is today. And so think of all the products that are being sold by the financial services industry: mortgages, partnerships, credit cards, reverse mortgages, partnerships in oil, gas, and real estate, annuities, mortgage-backed securities, commodities, stocks, bonds. And when I'm talking about products, financial products, all of those products in the brokerage world has a commission tied to it. And you don't need to do any of that. But in order to get you familiar with all these products and what the alternatives are, Michael and Paul have agreed to come on and talk about some of these products to you, so you're familiar with them and hopefully avoid them. Michael, you're a fee-only fiduciary advisor, and so is Paul. Both of their Ask First forms are on the website, and I'll let you let the folks print off those and go through it themselves. But I'd like for you to talk a little bit about your practice, and then we'll get into the program and how you charge.
Yeah, thanks, Pete. Yeah, I feel like we're the ringleaders of a circus with investment world. The title always feels like that, and there's always stuff being sold out there. And this dates back to the history of time, with tulips to today,
cryptocurrency,
mortgages, you name it. So we are a registered investment advisor, as Pete mentioned, a fee only. The only way we get paid is through a percentage of assets under management or on an hourly basis through financial plans. Benefit Financial Services Group is our firm. We've been in business and only as a registered investment advisor since really the early 90s.
Okay?
Oops. Paul, mute yourself. So we've together, our firm, we have a branch office in Phoenix. Our main office is in Irvine, Southern California. And we have about 33 employees firm-wide. And we do retirement plan consulting. And then we work with individuals and do full wealth management, from financial planning to investment management, you name it.
Okay. And let's say if I give you $500,000 to invest, how would you charge me?
So it's based on a percentage of assets. The goal is to grow your assets. Our percentage stays the same.
So what is that percentage?
Yeah, so it really depends what your needs are. If you want full financial planning and along with investment management, it's 1%.
1%
is our fee. But if you just want investment management, it goes down from 0.5 to 0.65.
And if we wanted to do a financial plan, would you charge an hourly rate on that?
Not on top of that 1%, but if you just want a financial plan only, then it's an hourly rate. The typical financial plan, depending on complexity, ranges from around $3,500 to $4,500.
Okay. Do you offer a free, will you review somebody's portfolio for 1 to 2 hours or however long it takes? And do you charge for that?
We do not charge for that. Yes, we do a free analysis and kind of what we call a discovery call. We'll go through what you should look for, but that discovery process is important, not just for us to understand what the goals and objectives are of our clients, but also are we the right fit and vice versa. This is we look at this as a marriage
Yes.
with clients, and we want long relationships. So you need to like the person you're working with.
Yeah. And by the way, if you, they know a lot of fee-only fiduciary financial advisors in the community. So if there's not a fit with them, they can refer you out, because it has to work for both of you. And so, you know, I recommend highly that you visit with 2 or 3 and spend some time with them. And because personality is important. I can guarantee you, Paul and Michael have the competency, they have the credentials, they're ethical and highly competent professionals. But everybody's a little bit different. And so from personality point of view, you want to, once you decide on somebody, you want to be with them for the rest of your life, or at least 5 to 10 years, so that, you know, you grow with them. And you got to have somebody you trust to talk about your money. So let's go through the program today. We're not going to talk about financial planning that much, but we're talking about the investment world, how it is today.
Yep. So should be seeing my screen now, Pete.
Yep, you got it.
All right, perfect. So real quick, just background on myself. I've been doing this for, I think, 17 years now, and working at one firm the entire time, which is rare in the industry. I've got my certified financial planner planning degree as well. Paul's got a longer list of credentials behind his name. We work as a team here, so that's nice to leverage his skill set and other people on our team skill set as well. I grew up in Orange County, went to UCLA, back in Orange County, and I've got two sons that keep me busy with sports. So
we just lost everybody who went to SC. So
that's okay. I'm okay with that.
Okay, Paul.
All right. So my role within the firm is I'm the senior financial planner. So work with clients doing financial planning. I myself am also a CFP, certified financial planner. I also hold another designation called CPWA, certified private wealth advisor. That's for advanced estate, tax, and investment planning. And then I do hold a master's degree in investment analysis.
You're one of the rare birds that own a master's degree in portfolio.
I am. I chose the master's instead of the CFA personally.
Yeah.
So
yeah. Well, congratulations.
Thank you. So alphabet soup behind my name.
Oops.
Okay. Let's start the program.
Yep.
Who's going to take the first slide?
I will. So
Okay.
we talked a little bit about fee-only registered investment advisor, but what really the 2 important aspects of trying to find an RA or registered investment advisors, they have to legally function under a fiduciary standard, which is always putting your best interest first, not their own. A registered rep or a broker, so the Merrill Lynch's, the Wells Fargo's, the JP Morgan's of the world, they have to operate under what's called the best interest standard. And it's a little muddied the last few years when they rolled this out, but really it's only putting your best interest at the time of the transaction. It's more of a transactional relationship than ongoing. And so what makes sense at that time, they can sell proprietary products and other things. Again, it's as long as it fits your goals and objectives. So I think that's a big difference. The other thing is you want to find a fee-only registered investment advisor because your interests are aligned. Someone selling you an annuity, a mutual fund with a commission, other products that we'll get into today. Again, I mean, it's more transactional. So I think those are 2 really important things to look for in the difference between a broker versus a registered investment advisor.
Is it easy? Is it easy to determine somebody who's a broker or a fee-only advisor from a consumer's point of view?
It's not. It's so confusing.
Hard.
It's hard. And actually only 20% of registered investment advisors are fee only. So even on the registered investment advisor, there could be conflicts as well.
Yeah.
Those conflicts have to be disclosed, and that's on the next slide. I mean, you have to, at the bottom of that, this Form ADV or disclosure brochure is required by the SEC or Securities and Exchange Commission. So you can go to that link, and that will tell you about the advisor, any conflicts, they have to disclose those, how they mitigate those conflicts.
Everybody should check out their advisor that they have presently. They should go to brokercheckfinra.org. If you have not done it, please do so. Every presenter that comes on the screen or presents here in our program, I check on Broker Check. I look at their ADV form. The brokers are very professional. They are trained to look professional. You want a financial advisor.
Yeah, brokers will go back to their headquarters and spend weeks going through marketing and sales training.
And they're good.
They're trained, they're good.
Yeah, that's what they do. That's what they got hired for. And I do not mean to imply that all brokers are unethical. Please, I'm not saying that. It's just that in the brokerage world, you're a salesperson. You don't get paid until you sell product.
Yeah, and Paul, do you want to maybe give a little background on that, kind of your path to?
Sure. Yeah. So I started my career, I was with some of the banks like JP Morgan, Wells Fargo. And I switched from the dark side, saw the light about 8 years ago. I was on a national sales call with my boss and my boss's boss at one of the banks, and doing very well as a new advisor there, doing very well. So just hoping for maybe like, oh, good job, Paul, an attaboy. Instead, it was, hey, you haven't sold any annuities this year. Why not? Why do they want me to sell annuities? Because that's what puts the most money in their pockets. So that's what's best for the firm. That's not what's best for the clients. So on that national sales call, getting called out for doing something that I didn't believe in, for me was the last straw.
Yeah, and I think that just shows, again, not that brokers can't be ethical and they're good people. Paul was one of those, but it's just the nature of the business and the pressure of the model of how it works, I think is.
Yeah. If you get hired as by Mercedes-Benz to sell cars and you don't sell any, you're not going to last long in that business. I don't care what kind of degrees that you have. And that's kind of the same way in the financial services business.
Yeah.
Certifications, are these credentials or are they licenses? I mean,
yeah, they're credentials. We'll talk about licenses in a second. Licenses are easy to get. I mean, we'll get into what those are. Like I've got a Series 65. It took me 2 weeks to study. I passed the test. I mean,
and how long did it take you to get your CFP?
2 years, and then you have continuing 30 hours, I think it is, of continuing education every 2 years.
2 years.
Yeah. So it's.
And what's the difference between a CFP and a CFA?
Yeah, so CFP specializes in financial planning, really from retirement planning, college planning, insurance risk management planning, you name it, we're touching the major areas, healthcare planning. A CFA or chartered financial analyst is focused more on the investment side. They specialize in investments.
Studying companies, how to evaluate a company. And, what I like to say, a CFA goes a mile deep into a company, whereas a certified financial planner goes a mile wide. So for a consumer, a CFP is what they probably should be looking for, because you touch on so many broad areas in a person's life.
Yeah, and we've investment planning as part of that CFP curriculum as well, but we've got CFAs as well at BFSG. So we've got, I think, 8 CFPs, 3 or 4 CFAs, a couple CPAs.
How much do you have under management?
We have
approximately
31, 1.1 billion in assets under management.
billion.
A
That's with a
billion.
B, right? That's
Yeah, with a B, yeah.
okay.
Yeah. And the last thing, I think, Pete, you're spot on. I mean, a CFP or certified financial planners, I think a credential that people should look for. And there's only about 30% of financial advisors have a CFP in the United States.
Well, you've got $1.1 billion under management, and you know the average equities portfolio for consumers in the last year has gone down approximately 20%. So what do you, both of you are been in the business for quite a while. What are you telling your clients? Are you telling them to panic? Are you telling them to get out of the market? What do you give a little bit of the spiel that you give your clients today? Because it's pretty scary out there.
Yeah, well,
It
we
is.
we stress for our clients. That's why Paul and I are have no hair left.
Yep.
Paul, you want to answer that?
Yeah, I mean, so for us, we believe in leading with a financial plan. The financial plan ties everything. Because with the financial plan, you can really understand your ability to accept risk, right? So as you get older, as you're younger and you're growing your assets, you want it to be more aggressive. But when you get close to retirement or in retirement, it becomes more important to protect the money than it is to grow it most of the time. And so a financial plan can help us kind of understand. And with the financial plan, we can show the client, if you have a 20% loss in your portfolio, how does that affect your lifestyle? What does that mean to you at the end of the day? And so we can measure things like if there's high inflation rates, if there's bad returns in the market, all that can be modeled into a financial plan to help our clients better understand kind of what to expect and how it impacts them, which is what's most important at the end of the day. 'Cause at the end of the day, that's what we want to know, right? How does this impact me and my lifestyle?
Yeah,
And that financial
and-
plan really helps us focus on the long term, because the rest of what's going on is a bunch of noise. It's a moment in time. It feels painful going through this, but if you can stick to the long term, we've seen time and time again, things work out. But if a plan is showing some type of stress, then what levers do we pull to be able to get the plan back on track? It's like a roadmap.
Yeah. Well, and we want to avoid a Bernie Madoff situation. So why is it important to have and to understand what is a custodian?
Yeah, you want a independent third-party custodian to hold your money. You want to get a statement from Charles Schwab, Fidelity, TD Ameritrade, whoever that third-party independent custodian is, because they're holding your money in your name. It's the Bernie Madoffs of the world held the money for the client and produced statements that were not true of what they were holding, and it was a big Ponzi scheme. So you want that independent third-party custodian.
And how do you have, what kind of power do you have over that account? In other words, can you take money out and go to France or you know, you got a big vacation planned and you could take money out of the client's portfolio?
No, only if the client wants to gift me that money, then great. But no, we have discretion over the investments. Clients give us discretion to trade and invest the portfolio, but on any money movement, it has to be directed from the client. They sign off on money movement, and it's only to directly to their bank account. We cannot accept any funds. We do not want custody of funds.
Yeah. No, I mean, if you're writing a check, you're making it out to Schwab or Fidelity or something like that. You're not making it out to the RIA.
Yeah.
Correct.
To you as a firm.
Yeah, correct.
Yeah. So that we're not going to go into the other, but those are, if you go back to slide just a little bit, confirm that you meet your individual needs. This is kind of the conversation that you should have in your first meeting. You know, talk about similar clients. How often do you meet? How do you make the investment decision? What services do you offer? Those are good conversation points to have on your first meeting with the financial advisor. What do you ask a consumer to bring into you on the first meeting?
A lot of times we like to just have a conversation with the first meeting to see where they're at. Just learn about them, make sure, we're kind of a good fit, they're a good fit.
You don't want
Ideally,
them to bring their brokerage statement in or?
ideally, any statements of any investment accounts they currently
Okay.
hold is ideal.
Okay.
Certainly not required for the first meeting, but definitely ideal.
Okay, let's go to the next slide.
All right, Paul, you're a
All right, so all industries are regulated by some governmental arm. For us in the investment world, that's the Security and Exchange Commission, the SEC. They're the government agency that regulates everything. Then aside from that, you may hear from time to time FINRA, which is the Financial Industry Regulatory Authority. And this is a self-regulatory organization. So anybody that's part of the New York Stock Exchange, they're registered with FINRA. They're trying to police themselves to try and mitigate or limit SEC's involvement so that SEC doesn't have to step in as much. But at the end of the day, the only one that really truly matters is the SEC because they ultimately regulate the entire industry, including FINRA itself.
And then the Securities and Exchange Commission operates on one basic philosophy. And that basic philosophy is full disclosure. And so everything about FINRA, ADV, prospectus is to give you full disclosure about the investment and the person, and then you, quote unquote, being a reasonably intelligent individual can make up your own mind. So, and then FINRA is about how do you control the sales world ethically, because they want to sell product, but how do you prevent fraud, manipulation, and deception? And that's where the licensing comes in. And if you go to the next slide, I think you have that on that.
Yep.
What are these?
These are, I call it pay to play, but these are your investment licenses if you want to sell investment products in the financial services world. And the reason I say pay to play is they're not really that difficult to pass. So for example, the Series 7 is the most common out there. And that allows an individual to sell all investments except for commodities and futures.
Is there a college degree required?
There's not.
Is there?
There's
So
not.
you have to be over the age of 18. Is there even
Yep.
a high school diploma required? I don't believe so.
I don't think so.
No, you just have to
But-
be 18 or older and be able to take the exam.
Yeah, you need to be sponsored by a firm, and most firms that are sponsoring you will require a college degree, but technically it's not required to get the Series 7 itself. The Series 24 is the person that is managing the Series 7. And then the 63 and 65 are important. They can be combined to be what's called the Series 66. So you may have someone that's just 7 and 66, and the 66 is just 63 and 65 combined.
Yeah.
But
and
anyone that
Go
has
ahead.
these licenses, anyone that has a 7 and the 7 is selling you something. They're going to make a commission off of it. So that is a good question to ask any potential advisor or your current advisor is, do you have a Series 6 or 7? A 6 is just to sell mutual fund. A 7 is to sell all products. But if they have those, they're selling you a commission product.
And that's why we ask you to, whenever you go with somebody new about your money, have them use that ask first form. How long did it take you to complete that ask first form?
There's a pain in the butt, to be honest. 20, 30 minutes probably.
Okay,
Remember?
not a big deal.
No.
No, but it asks about the
Yes.
credentials and it asks what licenses someone holds. And so right now, you and Michael and Paul, you guys basically hold a 65 series, correct?
correct. A CFP, I held the Series 65 and then I got the CFP after that. But if you're a CFP, you pretty much don't have to take the Series 65.
Yeah, and that's just a basic registration. It doesn't give you the right to sell anything. So it's
No, it's just
important to
basic
know.
registration, yeah.
Yeah, so a good financial advisor will not have any of these licenses.
Yep.
Okay, let's go to the next slide. this is one of the products, life insurance. Talk a little bit
It
about
is.
them.
So for life insurance here, there's really two types of policies. Term is the most common one out there. That's just a life insurance for a single period of time, typically anywhere from 10 to 30 years are the most common. The whole idea of term is you need the money now, but probably aren't going to need as much insurance in the future. So it's the most cost-effective way to get life insurance. And where we commonly see this is someone that's maybe just starting out in life, buying a home, and having small kids. Obviously there's a big insurance need there, but as that home gets paid down, as those kids get older and get through college, their need for life insurance is going to decrease over time. So a term can be a great way to get the coverage you need at an affordable cost. The other type of insurance is known as permanent insurance. And there's really three types here. There's what's called whole life, universal life, and variable life. All of these policies are cash value policies. So where you term policy, you may pay 30 bucks a month. With a permanent, you're probably paying 150, 200 bucks a month. And the idea on that cash value is not to accumulate wealth over time. The whole idea of the cash value on these life insurance policies is to make your premiums level or the same throughout your lifetime. So as you get older, life insurance gets more expensive. Simple concept. So with the cash value here, the idea is in those early years when you're younger, you're paying more than you need to. That cash value is growing over time in the policy, and that cash value can be used to cover those premium increases. So instead of your payments going like this over your life, they try and keep them level like this by having that cash value. Now, a lot of agents will sell this and they'll try to sell the cash value as an investment vehicle. Not what they're designed to be. Life insurance is not a good investment. Life insurance is great insurance, and there is certainly a need for it out there.
Yeah. And everybody should look. Isn't that one of the first things you review in a client's when you're doing a financial plan is what kind of insurance do you have?
What kind of insurance do you have? And do you have the right amount of coverage? And do you have the best coverage?
Yeah. And
yeah, a lot of times.
I'm sorry to interrupt you, Paul.
Yeah.
Do you guys get a kickback on when you recommend to somebody to get some more insurance?
We don't. So if there's a need for life insurance, we can promise you it's a need because we're not getting paid for it.
Okay.
And we won't sell it to you. We can refer you to a broker that can sell it to you, but we have no monetary gain by making that referral.
And
that's just out of the kindness of our hearts.
Yeah, I think the important thing Paul mentioned is a broker, because then they shop around for the best deal out there. It's not like we've got some internal product that and we get no kickbacks. I think the other important thing is, I mean, permanent has a place and it may make sense for certain people.
Sure.
Most of the time, term will suffice as the cheaper way to go. And most term policies actually have a provision to convert to a whole life policy without evidence of insurability. So I think there's a good argument for typically term, but permanent, it can definitely, a whole life policy can definitely make sense given each individual circumstance.
And how big is this life insurance industry with term and permanent? Billions?
Oh,
Trillions, probably.
Trillions.
yeah, trillions,
Yes.
probably, yeah.
Yeah, it's just huge. So let's go to the next product.
All right, annuities, which is really just a type of insurance, and that's what it is. And you've got really the main types are deferred annuities, and there's three types: a fixed annuity, a variable annuity, and an indexed annuity. And really, annuities, I mean, these have been around for over 200 years, really since feel like the beginning of time. A fixed annuities, you're just receiving a guaranteed rate of return. You put money in, you start getting that rate of return. Older contracts may have higher interest rates, but most contracts in the past 10 years really were yielding, I mean, 1%, and they haven't been great vehicles for that money to grow. Interest rates have backed up, and so they may become a little more attractive again, but It's just a guaranteed rate of money of return. And
I just
no
want to
risk of
make
principal.
one distinction here because we're sponsored by charitable organizations and we believe that giving to charity is a good thing. These are what Michael and Paul are talking about are commercial annuities. Very difficult to understand, written in very legalese type writing, very lots of pages. So you need a professional to understand them. To distinguish that from a charitable gift annuity that is 2 pages long, absolutely no commissions are paid to anyone. And I've never met a 90-year-old who doesn't understand it. And so I just want to make sure that that's distinguished from the commercial fixed annuity. Talk a little bit, if somebody has an old fixed annuity, should they get rid of it?
It really
Yeah.
depends on the client situation. You can always do an exchange to another annuity if it makes sense.
But first have a neutral person review it. Don't ask your agent to renew it, because if you bring a new one in or exchange it, you may be renewing another commission. So
You
be
got it.
very careful.
Yeah.
What is a variable annuity?
Yeah, so variable annuities were one of the most popular annuities sold for a long time because you can invest your premiums into stocks and bonds, mutual funds. The problem is they carry investment risk, so your money can go up and down, and the underlying investments are limited, and they're typically higher cost mutual funds within the annuity.
And everything that comes out of a variable annuity is ordinary income. You can't get capital gains out of them either.
Yeah, it's all ordinary income. So you defer taxes, but it's all ordinary income.
Yeah, and the worst type of annuity that's being sold today, which is the most popular, and you can get a lot of free dinners and free lunches, is the indexed annuity. And what's the pitch there?
Yeah, so you get all the upside of whatever index, like the S&P 500 large US stocks, with none of the downside, and there's no cost to it. That's the pitch, which is not true. You do get upside. Usually they cap you on the upside, and then they limit your downside. Maybe you'll have a floor of 0% where you can't lose that money, and then you get capped at, say, 10%. And then they say no fees, but it's really just coming out of the underlying. If you read through the 80 to 200 page prospectus and all the memorandum, then you see where the fees are. But typically the index is charging a fee of 75 basis points to 1%. So it's higher. You can go buy the S&P 500 for 2 or 3 basis points, or 0.02 or 0.03%.
But the pitch is so great. I get
It
the
is.
upside and I don't get the downside.
Yeah.
You know?
Yeah.
If it's
Yeah, go
if
ahead.
it sounds too good to be true, it probably is
Yeah.
not true.
Yeah, we're going to show an example later on, but I think one of the important things is to know about index annuities. There's lots of different ways they measure the year-over-year return. They have different structures, but one of the important things is you don't get paid dividends within these. So the S&P 500 dividends since 1926 have contributed approximately 32% of total return for the S&P 500. So you're pretty much losing, I mean, the dividend and what has historically made up a third of returns.
Yeah.
So that's important. The other thing is, I mean, about 40% of annual returns fall within the negative 10 to 10% range. It's like a normal bell curve distribution. But 47% of those returns have been above 10%. And when you're capped at 10% and you're leaving almost 50% on the table, that's why they're making money, is because they know these things and they're taking advantage of that.
Yeah. You know, these are so bad that the major brokerage houses don't even sell them. You can't buy these from a Merrill Lynch, a UBS, Edward Jones. You can only buy these from some other smaller independent brokerage houses because of suitability. The expenses are so high in these things. Let's go to the next slide.
Yeah, so touching on expenses, like you said, Pete, I mean, one, there's the surrender fee. So what is a surrender fee is really, I mean, these are meant to be long-term type of, I wouldn't say the word investments, but long-term contracts. And if you try to get out in the first year, second year, it's usually a scaled down surrender penalty. And the typical 7 years, but we've seen contracts with 15 years of surrender penalties.
So
And so it's not uncommon. And that's, I mean, 8%. So if you go, oh, I want to put in $100,000 and oops, I need this money back. All of a sudden you're paying $8,000 in a surrender fee that first year. You can always get 10% of the money out each year without penalty. But these are not liquid investments. Unfortunately, they get sold to be as, hey, invest, you can get your money out. And unfortunately, they get sold to seniors a lot when
Yeah.
you need liquidity.
yeah, and liquidity is so important when you get to be a senior.
Yeah, and I
Yeah.
think going back to the other slide too, real quick, was you mentioned these are tax deferred products and then they produce ordinary income. The other thing we see so often is annuities being held in retirement accounts in a tax deferred vehicle, which is just, I mean, it's
Almost outrageous.
yeah. Paul, did you want to add something too?
Yeah, I mean, the whole idea of an annuity is the original concept of an annuity was to be a paycheck for the rest of your life, a self pension, if you will. And there's still that type of annuity out there called a single premium immediate annuity, or just an immediate annuity where you give the insurance company a lump sum, they give you a paycheck for the rest of your life. Those are very different than what we're talking about here, where now they're trying to take these annuity vehicles and turn them into investment products, which, as we're discussing, you'll see typically doesn't work out to your favor.
By the way, your typical commissions on the annuity can be related to whatever surrender fee there is. So for example, on this one, if they sell you $100,000 annuity on a fixed income or variable, the surrender fee is $8,000. And that $8,000 goes to the individual that sold you the contract. And remember, on all insurance products, you got 30 days to rescind, and that works on annuities as well.
Yeah, an annuity, again, is just an insurance product.
Yeah, it's very difficult to understand them. Let's go through some of the cost.
Yeah,
All
Paul,
right.
you want to walk us through this? Yeah.
Yeah, so this is for what's called the variable annuity. Again, this one, the money's invested in a mutual fund, and you make whatever it does, and you lose whatever it does. So with these fees, it is really difficult to understand this. So we broke them down, the four most common types of fees. The first one is the mortality and expense ratio. This is the actual cost for the actuary estimates for the annuity. That's typically around 1.25%. A lot of times they will have on top of that an administration cost. This is your paperwork filing and your mailing fee and all that sort of things. And that's also 0.25% of the contract. So you're already 1.5%. And then we look at what's called the fund expense ratio. This is the cost for the actual mutual fund that you're invested in. That's typically around 1% as well. And then these annuities aren't sold to be just that investment vehicle. They want to sell you guarantees. So they'll have what's called this living benefit rider. And essentially what happens is it makes the annuity instead of being a 1-lane highway, the living benefit rider is kind of like a toll road that you can jump on as well. And so you pay for that. They're going to give you certain guarantees. Those guarantees typically don't work in your favor. But it's an extra fee that you can pay. So all in, most of these annuities that I see come in around 3 to 4% per year. So if you're making 6 or 8%, which is the historical average, and you're paying 3 to 4, you're giving up 50% of your returns or more potentially just to the fees.
Yeah, and expenses is one of the things when you're doing investing that you can control. You can't control market returns. But that's why expenses are so important.
The best indicator of future returns is having low expenses.
Yeah, Let's go to the next slide.
All right, so this slide right here shows why the bane of Pete's existence is these indexed annuities. What we have here is a contract, and this is an actual client's return, actual client's contract. This was in a year the S&P was up over 15%, that 15.76% number on the left. How this annuity works is it has what's called a monthly cap of 1%. So in any given month, you cannot make more than 1% return. So look at month one, markets are up 3.285%. They're capped at 1, so the client makes 1%, the insurance company makes 2.285%. Next month, the annuity's down 2%. They're nice to cap you on the upside, but they don't cap you on the downside. So the markets are down 1.3, their return is down 1.3. So now their return for the year is already negative. And you can see here, they're capped 1% each of those other years where the markets are doing 5%, 2%, 3%, 2%. And then we had these two big losses in July and August of over 10%. So their loss on the year now becomes 20%. They physically cannot catch back up. They end the year at negative 6%, even though the S&P itself was positive 15%. So this is how in even a really good year in the stock market, you can still get it no return on these products.
And by the way, the client didn't lose any money that year.
No,
But they didn't make any money that year either. Who made the money? The insurance company.
all 15% went to the insurance company. You got it.
Yeah. And by the way, and you got a free dinner and some wine, usually at the when they sold you this contract. But there is just no free lunch in the financial services industry. And just say no. I love Nancy Reagan on drugs, but I like it best if she would have done that to the financial service products. Just say no. Let's go to the next slide.
All right, so let's go ahead and move on to mutual funds. And what is a mutual fund? It's simply your money being pooled together with other investors. So instead of, let's say you come to us with, say, 100,000 to invest. Instead of us taking the 100,000 and buying individual stocks for you, what we can do is go put it out in a mutual fund where that mutual fund has your money plus tens of millions or even potentially billions of other people's money combined together to have much larger purchasing power to buy a specific, maybe it's the S&P 500 index or whatever the goal is for that mutual fund.
Yeah.
So that's the first step.
And there's 28,000 mutual funds just in the United States alone.
So the money's pooled together is the first step. Then you have a fund manager that's going out and choosing the investments for the account. And then at the end of the year, the returns are given to the investors minus that annual expense ratio, which is the cost of running that mutual fund, which is typically around 0.75 to 1% on average.
Let's go to the next slide.
All right, so with mutual funds, if they are sold to you by someone that has their Series 6 or Series 7 licenses that we talked about earlier, they're going to come with commissions because the advisor selling it to you needs to get paid. And the most common one out there is what's called a Class A mutual fund. This typically has a payment of about 5.75% is the commission on this product. So if you invest 100,000, you only invest $94,250. The remaining $5,750 actually goes to the broker and his firm.
It works
So
a
you're
little bit
already-
like real estate. You know, when you have a real estate agent, part of it goes to the real estate agents themselves, and part of it goes to first team, a Caldwell Banker. The same thing is here. And each individual broker person negotiates with their firm as to what part they keep. So you'll see a lot of brokers changing firms. And the reason for that is the next firm is promising a bigger payout to the individual.
Yep. So, A shares are designed to be long-term investments. You pay the 5.75 up front, and then you don't pay any other commissions going forward. So it's designed to be a long-term sort of investment.
You
And an
still do-
ethical
Yeah.
broker will sell you a Class A and not get you to do another transaction.
Yeah, but you are still paying that mutual fund expense ratio that Paul talked about.
Yeah, we're gonna go through that. I
The
think.
1%, yeah.
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 We'll come back to Class B in a second. Class C is designed for a short-term investment. So instead of having that large upfront 5.75, instead they charge you nothing upfront, but they charge you 2% on average per year. So if you invest 100,000, 100,000 is invested day one, but now you're paying 2% per year over a long period of time. So Class C was designed for short-term investing, think less than 5 years. Class A was designed for long-term investing. However, a lot of advisors will now sell Class C and just keep you there because they're getting a higher commission over the long term. A Class B is still technically legal, but I haven't seen any firm sell these in at least 5 to 10 years. These were a Class C share that turned into a Class A share Class A share that turned into a Class C share down the road. So they were the worst.
Yeah, dude. So if you're with a broker and you see your statements, they'll have a class and an alphabet number or letter behind that mutual fund name. And by the way, they have many, many other categories: A, B, C, D, E, F, G, H, I, J, K. And you'll have to go to the prospectus to see what that means. But if you look on their mutual funds with loads and mutual funds with no loads. So take a guess as to what most people have. Most people have mutual funds with loads.
Yeah.
Mutual funds with no loads are like Vanguard, T. Rowe Price, name some
Schwab,
others.
Fidelity.
Fidelity.
You cut out the middleman. There's no commission as a result. So all the money's invested with the mutual fund company. They tend to have lower fees. And then if you're working with like an RIA or investment advisor, like Mike or myself, or someone like us, you're not using either of these. You're using what are called institutional shares, which have the lowest fees in the industry.
Yeah. And fees matter,
Yes.
on an annual basis. Let's go to the next slide.
Yeah, so again, feel like that investment world circus. There's always some new product being pitched, and today it's Bitcoin and other cryptocurrencies, and how they're getting sold as well. And it's just I think the SEC commissioner said it the best. The cryptocurrencies like the Wild West right now, and so we caution, not saying it may be feasible in the future, but it is the Wild West. When we look at it, is it a currency? It's not a store of value. It's really too volatile to be one. I mean, can you imagine having crypto in your wallet or on your phone to go buy a cup of coffee, and you walk in and that cup of coffee is $2, and then all of a sudden your Bitcoin crash and now that cup of coffee is $5. So it's not really a store of value. It's too erratic. It's too volatile. And that's what that chart on the left is showing, just the volatility and how it swings compared to other common investments from gold, stocks, commodities like oil and wheat.
Well, talk
copper.
a little bit about, should people have right now, usually people rush to gold when there is a tension in the world. So should people have gold in their portfolio?
There could be an argument for having gold, but it's really worth what someone else is willing to pay you for it. There's no value to it in the sense that it doesn't produce cash flow. So that's the hard thing and why actually gold has declined this year. When you see, like you said, Pete, like, shouldn't gold be positive? There's a rush to it when there's geopolitical crises and stuff. It's, well, interest rates have skyrocketed this year, and I can go buy a 1-year treasury bill that's principal protected and get 4.5% or so today, and gold's paying me nothing. So there are drawbacks to gold. If you do want to hold precious metals, just know they're volatile. They can go through long periods of underperformance or outperformance. And I wouldn't hold very much of it if you do hold it in the portfolio.
Let's talk a little bit about stocks. I watch Jim Cramer on a regular basis, and I get excited about, individual companies that he promotes. Should I go ahead and buy those individual stocks, put them in my portfolio? Is that a good investment decision?
Talk about the
So if
ultimate
it's Jim
sales.
Cramer, if it's Jim Cramer, he does so well that there's an inverse ETF doing the exact opposite of whatever he's recommending.
What is an inverse ETF?
It means doing the exact opposite. So
There's
what
a
is it?
fund out there.
What is an ETF?
an ETF, good question. An ETF stands for exchange traded fund, and it works very similar to a mutual fund where it's a pool of your money with other investors. There's some minute differences. Mutual funds go back to the 1940s. ETFs have been around now for about 15, 20 years.
Yeah, a little longer, but yeah, something like
Yeah.
that.
Are ETFs, are they all the same? So if I buy an ETF, I should be okay. I just need to know that they're an ETF.
No, ETFs are not all equal, like everything in the investment world. The difference with the ETFs is they could be passive or active. And I think we have another slide on that. Is that right, Mike?
No, I don't think so. So yeah, why don't
Okay.
you clarify what that is? Well,
Okay. So a passive approach is going to be what, Vanguard's the most common example out there. That's what Bogle, the founder, his whole kind of investment thesis is I'm not going to try and beat the market. I'm just going to try and replicate what the market does. And as a result, keep the fees as low as possible. So that's the idea of a passive investment.
And then an
then
active is?
Active is someone is trying to beat the market. So they have some investment strategy that they're using to try and get better returns in good years and reduce the losses in years like we're having right now where the markets are extremely volatile.
So a Jim Cramer is an active stock picker. And what I see a lot in accounts, I'll get to you in a second, Don.
Thank you.
Is in the brokerage world, wrap accounts. What are they? And let me know what you think.
yeah, it's really, I mean, kind of like it's just another investment product, kind of like a mutual fund. You're having a manager pick and choose stocks, but the account is actually held in your name. It's not pooled together with other investors. In a sense, I mean, that manager, maybe they're managing a wrap account for a bunch of other people, but it's just in your name. So you actually get to see the underlying holdings. So a little more transparency, but still the fees are there.
I
On
see
a
'em.
typical wrap account of anywhere from at the low end 0.5% to typically more like 1.5%.
I've never seen them at 0.5%. Usually they start at 1.5% to 2.5%.
Yeah, much higher fees typically, unless you're doing like some type of passive type index wrap account.
Yeah.
But yeah, it's much higher.
When you
fees.
hear wrap account, explore.
Yeah.
Don, what's the question?
What's the distinction between a passive ETF and an index fund?
It's the same. So a mutual fund, passive mutual fund, and a passive ETF, or they track an index. They're the same exact thing.
Use the S&P 500 as an index.
Yeah, so you can go buy the Vanguard S&P 500 index mutual fund. Then you can go buy the Vanguard S&P 500 exchange traded fund.
Is there a
They
cost
hold-
advantage or a return advantage?
There is no return advantage in a sense because they're holding the same exact holdings, and typically have actually the same exact fees. Where the advantage is the way an exchange traded fund is created and redeemed, it reduces capital gains. So they're more tax efficient. vehicles. So in a taxable account, you typically want to avoid mutual funds because they're not as tax efficient. You want to
Okay.
hold more exchange traded funds, but they're the same exact holdings, underlying performance, fees are typically the same as well. If you've got the same Vanguard S&P
Okay.
500 index mutual
Yeah.
fund.
Thank
Vanguard
The other
index.
major difference is that with an ETF, you could exchange them every day on the stock exchange. Whereas a mutual fund, you have to exchange them at the end of the day.
Yeah, so you get end of day pricing. So for West Coast, it's 1 p.m. Pacific Standard Time. So you sell the mutual fund at 10 a.m. You don't know what price you get until 1 p.m. At the end of market close. Whereas an ETF, you're going to get the price at that very second you sell at 10 a.m.
How about commodities? Should we have commodities in our portfolio?
Yeah, again, very volatile. And if you decide to hold anything, it should be very minimal because you see the volatility. Like I'll give the example of oil. I mean, the last 5 years, oil's been in the dumps, and then all of a sudden it skyrockets this year because of what's going on in the world. And at one point, I think oil was up 40 to 50%, maybe 60% this year. And now it's back down to 0%. So you haven't lost money in oil this year. So it's been, if you had 100% of your money, it's been great, but it's been a wild ride. So, and that's typical of commodities. Volatility is very high.
Yes,
So
John.
if I was 30 years old, what would you suggest I invest in?
Stocks and bonds, the typical asset classes, but more heavier in stocks because they've provided good long-term growth. They keep
By the
up with
way, and
inflation.
we're going to do that
And we're going to do it next week.
next
in more
week.
detail.
How to invest. This
Right.
is all
Okay.
about how not to invest.
Yeah. So yeah, that's a little primer for next week.
Yeah, we should name that instead of the investment world, how not to invest in the investment world. What does
Yeah.
IG mean?
Investment grade bonds. So bonds issued by corporations. So say you're Apple and you need to go build a factory. They're going to go to the market and go, I need to raise $1 million to go buy a factory to build new Apple watches. And then they pay a rate of return to investors to help them fund building that factory over a certain period of time.
Should individuals be buying individual bonds from brokers?
Not typically, no. We don't recommend that because we talked about commissions on other products. You get killed buying individual bonds. Typically, the spread or the commission that the brokers making is pretty high. So unless you're buying individual bonds in large quantities, then no, it's typically not worth it.
By the way, what is a large quantity when you buy a bond?
I'm talking, I mean,
Hundreds of thousands. Hundreds
Yeah.
of thousands.
Like not 15 to 20,000, which
Yeah.
you typically see in someone's portfolios, anywhere from 10 to 20,000.
Yeah.
Those bonds, you're getting killed on the underlying spread of buying that bond.
What about what does core CPI mean?
Yeah, so that's inflation, the volatility of inflation, which has increased this year. But this is since 2013. Inflation is pretty stable. That's one of the Federal Reserve's mandates is price stability and full employment. They're not hitting that price stability measure this year. That's why they're lifting interest rates.
Yeah, and we're going to be talking about this next week, but that's why you should probably have equities in your portfolio just to protect you from inflation.
Yeah, when we look back since 1942, the last 80 years, what the S&P 500, the US stock market common index for measuring that has done, inflation adjusted over the last 80 years is 8% per year. So we've been through really bad times of wars, of inflationary periods, and the markets climbed that wall of worry and has kept up with inflation. So that's why stocks are important, is to have some growth aspect and keep up with inflation.
How much cash should you have in a portfolio?
Yeah, we typically recommend anywhere from 3 months to 12 months of emergency reserves, not typically in the portfolio, but outside, because there's no reason to pay management fees on a cash position.
Yeah.
So it depends. I mean, if you're retired, probably, and what's comfortable in your situation, 6 to 12 months. If you're employed and you feel you've got job stability, 3 to 6 months.
Okay, let's go to the next slide.
Yeah, so I think just kind of concluding on hot tips. We talked about cryptocurrencies. You saw it last year on some of those speculative stocks like GameStop and other ones. There was that FOMO, or fear of missing out, which is to the far right of this slide. There's always some type of new investment that you need to be invested in. Don't miss out. From the tech stocks, I talked about tulip bulbs back during the Dutch tulip mania. This has gone on through the history of time.
I know. A tulip bulb today maybe run $2.50 or something like that, maybe $3. These were selling at the time for $200+ dollars.
Yeah,
In
and
the
back then,
60s,
inflation adjusted. You
back
can
then,
imagine what that
Yeah,
was.
yeah, and people were buying it. I mean, this is not made up. And then you got, I haven't heard about the South Sea bubble.
That was, I mean, pretty much during the beginning of, go back to Lloyd's of London and the beginning of kind of global shipping. The South Sea Company pretty much owned every trading route out there and was the biggest kind of speculative stock out there at the time.
The next two, the Panic of 1792 and the 1840s in Britain, reminds me of today, where the Prime Minister just resigned today.
That's
because
prime ministership ever. I think 2 months.
Yeah,
on board.
6
yeah,
weeks.
because of the investment. We always think that there's a guru out there who knows what they're doing, and there are no gurus.
No, I bottom line, stick to a long-term plan and what's worked over history, a consistent investment plan, and don't chase these fads and hot tips.
Talk a little bit about meeting somebody who grew up in the Depression.
Yeah, my in-laws, I mean, their parents grew up in the Depression, and they still, I mean, I hear stories of, using ice cream containers for storing food and stuff because they couldn't afford. So you have that mentality. Going back to 2007-8, people still, it was the worst recession since the Depression, and the mentality coming out of that. And this is where you get preyed on, is volatility always happens. That's part of investing. And it's having that long-term plan, that financial plan that we talked about earlier, and sticking through that plan, because that's where you get preyed on, is like these annuities. Hey, the index annuity, they're all over the place now.
Yeah.
People go, hey, you wouldn't have had the losses that you've seen. But if you have a long time horizon, as I said earlier with the S&P 500, 8% annualized, and I can go back 50 years, 25 years, 15 years, it's been pretty much compounded, inflation adjusted 7 to 8% over time.
Yeah. Well, and also since the Depression, we've got now FDIC. So there's no more run on the banks. You're protected up to $250,000. There are now exchanges, the New York Stock Exchange, Chicago. Why is it important to use these exchanges to buy or use financial products versus private partnerships, private deals? Why should not somebody use talk a little bit about the exchanges, why that is important?
Yeah, and we'll talk about REITs and some of the other things that are private, but I think when you look at the exchanges, there's regulation around that. They have to file certain things, more transparency. You don't have that transparency when you're buying private investments. And not to say that there can't be a case for private investments, but it's again, you just don't have transparency. Like, so for example, real estate or real estate investment trust, that's what REITs stand for. A lot of these can be sold in the private marketplace. They're not in exchanges. So, and they only get valued once a year. And so you don't know that, you think you see a stable value on your statement, and then and during volatility, but then it gets marked a year later down, and you see that. It's just, you don't see the day-to-day, kind of like your house. People think real estate's not volatile. It is. It's just not getting mark to market daily. And that's what the exchanges really show as transparency and more regulation to protect investors.
And it gives you liquidity.
It gives you liquidity. Yeah.
Yeah. And so, and they do, before you can get on the exchange, you have to have certain requirements in a company. So yeah. There are some, you know, gosh, name a company that just in the last 10 years that went under, that was on the exchange. So even exchanges can be fooled, but more than likely it's the best protection that we have.
Yeah, and staying diversified, I think going back to those exchange traded funds, mutual funds, buying a basket of stocks and being diversified. Because if one company does go under bankrupt, it's not going to blow up your portfolio having just that one stock in your portfolio or very concentrated. So
I just want to check with Paul. Paul, you were alive and active in the .com area. What was your experience during that time?
It was rough. It was rough. You know, during the .com bubble, a lot of clients lost money and panicked, and yeah.
You had 3 years of negative returns from 2000, 2001, 2002. So it was a tough time, but if you stayed diversified and you weren't only in the tech stocks, you actually did pretty well during that time frame. It was just the bubble stocks, those tech stocks got crushed.
Yeah. In other words, avoid media hype and don't listen to your neighbor.
Yeah.
Okay. What is a real estate investment trust?
Yeah. So it's, again, pooling money. Just go on the top left, investors purchase shares, you pool. Then you're going out and acquiring real estate, office properties, mall properties, storage units, you name it. You can also buy loans or debt of real estate. Then the income coming off of those properties. So say, for example, office property, we pay our lease here, that income, net income comes back to the REIT, and then they distribute, they have to distribute by law 90% of it. And you get monthly cash distributions back. But there are all different types of REITs. You can go buy public REITs. You can go buy like an office REIT in the public market. And that's on an exchange. So liquidity again. But there are private REITs, as I discussed earlier. So
they're quite illiquid.
Yes, very illiquid. Typically, the illiquidity is 5 to 7 years is what gets pitched as the time horizon. But we have seen private real estate take 10 to 15 years to get out of. So yeah, liquidity is an issue. And then the costs are very high. So there's something called non-traded REITs or DSTs or Delaware Statutory Trusts. You typically see a 5% upfront commission, another 2 to 2.5% acquisition cost for the buildings that they're buying, another 3% ongoing property management fee. And then when they sell the building, there's a 2% disposal fee. So really for every dollar invested, you're only putting in like roughly 87 cents into the ground. So you're already down 13% and that investment has to make that up over time.
Do you guys have some public REITs in your client portfolios?
We do. Through various mutual funds, exchange traded funds, they hold REITs. And real estate's an asset class that we think you should have exposure to. But again, you shouldn't. It's
small percentage.
Yeah, smaller percentage. Yeah.
Yeah. There, you know, a lot of people try to categorize, is this a good investment? I get that question a lot in the workshop series. Should you be looking at investments that way, as good or bad? I'm thinking about, like, for instance, junk bonds. Just by the name, it sounds, you know, kind of suspicious.
I guess
So-
you can always make the case if it's a good or bad investment. It's so, like, for junk bonds, they're riskier, but the discount in the price may be priced in. Like, so during like 2007-8, those junk bonds defaults went way up, and so the price of the income of those bonds skyrocketed because of concern. And so they eventually, I mean, they went down 20% plus during the downturn, but all of a sudden they were kicking off high teen returns in income, 15, 16%. And at one point they became a good buy. So I think that argument may be made, but it, again, you want diversification. We're not saying go put all your money in junk bonds or all your money in treasury bonds or whatever it is. There can be arguments it's a good buy or a bad buy.
It's a well-diversified portfolio, understanding and balancing the risks and trying to keep taxes and fees as low as possible.
And
That-
for each client's situation, I just looked at a statement yesterday of a new client. Their account was at Wells Fargo. She's almost 100 years old, and they bought a Puerto Rico bond. Puerto Rico's in default, by the way.
Yeah.
It has an insurance wrapper, so the cash flow continues to go. But and then they bought a longer term government bond, which is high quality, but they bought it maturing in 2040. And she's 100 years old. Why are they buying a bond that's 40 years to maturity?
Yeah.
It's just
And no
crazy.
liquidity, you know.
And no
Yeah.
liquidity.
Yeah.
So you
Yeah.
see these things, and it's just like it drives you crazy.
It's crazy. Let's go to the next slide.
Yeah. Well, the last
By the
slide,
way,
wrap up.
I'd love to put Paul's quote on the wall and get it transported to every person around, because that sums up how you should be investing. So if you want to remember Paul's quote, you got to go to the video and go back. Talk about this reverse mortgage.
Okay, so reverse mortgages are designed where if you have home equity, this is a way that you can use your home equity to cover retirement expenses. Essentially turn your home into a paycheck. 10 years ago, these were really, really bad. So they were out here. No client should have used them. Now the pendulum's starting to swing. They're more towards the center, so they're more balanced now. That's because of a lot of legislation that has come out in the last 5 to 10 years. But the idea here is you get a loan on the home, then you use that loan to pay for your living expenses. And then you go up to the home equity. And then when you eventually pass away or move on from the home, that reverse mortgage has to be paid off. So if you ever, pass away and then it goes to your heirs are either going to have to use cash to pay that off, or they're going to have to finance the property to pay off that reverse mortgage.
It's a product of last resort.
It absolutely is. Absolutely. If you're older, you run out of assets, you have a home and you want to stay in your home, it can be an excellent solution in those sort of circumstances, but it is something we back into. It's not something you ever lead with. And this product is so difficult to understand. It's the only product I know in existence where you have an independent third party that you have to have a conversation with, and they're going to make sure that you have the mental wherewithal to understand, and they feel that you're competent enough to buy this product.
By the way, that counseling is that bar is so low, it's unbelievable. So
Yeah.
I would recommend highly, if you're thinking about a reverse mortgage, see a fee-only fiduciary financial advisor before you purchase a reverse mortgage, because it's compounding in reverse. Your debt continues to compound so long as you live there. There's fees, monthly fees charged that get added to that as well. And then if you do have to go into a board and care, or you do have to move because of a physical illness or mental incapacity, you have to sell the property. You cannot rent it out. You cannot keep it. You have to stay in the home. So there's a lot of downsides to this product, but I'm happy that it's there because it's a product of last resort. It just isn't sold that way.
Correct.
That's why I got a bad rap. I mean, 10 years ago, it was getting sold as, hey, take equity out of your home and then invest that. which is
Bored,
just like,
go to the beach,
criminal.
go to Puerto Rico and, and have a vacation.
yeah,
Yeah. Let's go to the next slide.
that's it. We're good.
Okay, Don, why don't you come on back on board? And go ahead and take the stop screen sharing and put us all on. And
No, they need to flash in the disclosure before they turn it off.
Just did
okay.
it. Just did it.
As the
Yes.
compliance officer, you need to make sure that it's there.
It is. I made sure of that.
I thought that was a very good try. I noticed the title and I noticed, okay, that's what he's doing.
Yeah,
Yeah.
we have about 5 minutes left, and we encourage questions. If you have a particular financial product that you have in your portfolio now that you have a question on, feel free to ask.
The one
And-
caveat I'm going to make to that, and there have been numerous questions of which stock should I buy, or this bond any good, or something else. Specifics on equities and bonds are next week. So I've been deferring people into, that's a next week question. And so if someone get, what do you think of Apple's such a, we're not going to do that. I wouldn't do that to you guys. So
But what
actually, we've covered all the questions along the way.
Well,
So
one of the things that we haven't talked about in your firm is that when do you consider yourself a blend of active and passive, or do you consider yourself active managers? And if you consider yourself active managers, what do you do to try to pick out the managers?
Yeah, so we consider ourselves a blend. We
Yeah.
think there's certain asset classes like US large stocks that are efficient. And we think it's very hard to beat the S&P 500 over time. Whereas there's other asset classes and history has shown and that it's hard to beat. There's just a lack of information out there, and it requires boots on the ground. So like international stock investing, then we will find an active manager that we think can outperform the index. Certain
Yeah, I mean,
indices are
just
very
think of it like, if we're trying to invest in China, their rules are very different than ours. We want a manager that has boots on the ground in China that can go to these businesses, interview the business owners. So that's a good example where we might use an active manager.
Let me take us back to a thread we had a moment ago on the reverse mortgages. With the reverse mortgage, if the owner dies, does that mean the heirs have to pay off the mortgage?
Correct.
Okay, so
Or
either
you
sell
have
the
to
house
sell-
and pay it off,
Yeah.
or you have to pay it off. at
And
that
you
point.
have to sell that house within a limited of time. You can't just say, hey, I want to sell it 9 months from now. You've
Right,
got to
right.
get it sold
Yeah.
Right,
immediately.
yeah, okay. What about a home equity line of credit for living on it in your retirement?
You'd be better off with a reverse mortgage based on how the fees and everything else work.
Yeah, the problem with a home equity line of credit is it floats typically, it adjusts. So
Well, it requires a payment too that you don't have to make with a reverse mortgage.
yeah,
Yeah, one of the things that I usually ask people to think about and to analyze is, do they really need the home that they're living in? 3 bedrooms, double garage, a yard, and can they, kind of buy down a smaller place? And then you got equity, and you're living in a smaller unit, but maybe a 2-bedroom instead of a 4-bedroom, but it's something more affordable. So, is there another question, Don?
I'll go ahead and I'll ask the question, although it's a different sort. So in the case of this reverse mortgage, if, for instance, the lady who was typing it, I'm assuming lady, pardon me, hubby's sister has this and lives in another state, would the husband be, person asking the question, would hubby be considered an heir if there's no children?
It would
And my
go,
answer
so
was going to be, it depends on her estate plan and
is
what she
exactly where I
has
was
as to what's
going.
going on.
And how title is held.
But if that house has a reverse mortgage, one way or the other, it's going to have to be paid off, or the house is going to have to be sold to pay it off.
Correct.
So,
yeah, a bank's not gonna lend just out of the goodness of their heart and not get some type of money back.
right,
So
yeah.
someone's
right. So
paying that. if it's not you, it's your heirs.
Right, yeah.
Yeah, one of the other fee-only advisors the other day told me, said 20% of my time is spent on helping people invest their money. 80% of my time is spent helping them make financial decisions. Is that true in your practice as well?
Oh, yeah, I would completely agree. With all my designations and everything else, the one I didn't mention is the most important, and that's my undergrad in clinical psych. I mean, my wife calls me a glorified hairdresser, is what she calls me, because at the end of the day, most of my job, what I do, is helping people with their financial problems and providing education so that they can hopefully make the right financial choices.
Because who do you trust? Who do you trust with my money? Because everybody wants it. Everybody wants to make money of it. And that's why it's so important to really have that relationship and understand what a fee only is and a fiduciary is. We are out of time. I can see you.
Good, Pete, very good. So thank you guys for helping us with this week in terms of what the investment world is. And I like Pete's sort of subtitle. In a way, this is what not to invest in per se. Next week, we will be covering stocks, equities, and bonds. And we thank you very much. And I'm going to turn off the recording.